Welcome everybody to our business valuation and transition webinar hosted by BDO. We have three experts from BDO that will be presenting this morning. So if you heard me earlier, please type any questions you have in the chat box down at the bottom. Hopefully everybody can see their chat box in the toolbar down at the bottom. And they'll answer the questions after the full presentation, so we can go back and forth. And because we're a small group, we could unmute, but type your questions in first so I can monitor the chat box. So I'd like to introduce our three experts from BDO. Brent Van Paris, he's a CPA, CA, CFEA, a partner and business transition services from BDO. Just give them a little wave, Brent, or they'll see who you are. Okay, then JP Barnaby, did I say that right? He's a CPA, CA, and CBV partner in financial advisory services with BDO. And last but not least, I should have asked this in the question or when we were talking earlier, Wayne Tolker?
Tolker, yes.
Oh, I wasn't too bad.
Nope.
He's a CPA and CA and CFEA, and he's also a partner with Business Transition Services at BDO.
Tax partner.
Tax partner. Oh, you know what? I did that wrong. He's a Canadian tax partner, so he's your tax expert today. So without further ado, I'll turn it over to Brent, and we'll go from there.
Okay, thanks, Kim. I'm going to share my screen, and I expect everybody can see it. I hope so. They say when you're doing a speech that you're supposed to picture your audience naked, but I can't see any of you, so there's not going to be any of that today, unfortunately. I can see Wayne and JP. Well, that doesn't make it for me. So thank you for joining us. We're going to go through today a little bit of discussion around business transition. Transition means change, and often it's a change of leadership and ownership from one generation to the next, bringing that next generation into the business. My role with BDO is I lead their business transitions group, so I work with families that are actually going through that type of change and other stakeholder groups and other types of change. So I'm going to talk about the planning and the facilitation side of it. And then we have two experts with us to talk about some implementation. JP is going to talk about valuations of businesses, and Wayne's going to talk about the tax implications of transition. So it says be prepared. So when you're preparing for transition, you're actually preparing for either your exit or your entrance into the business, or a combination of both of them. And we know that a transition can, we're hoping it's going to be on your terms, when you want, how you want, to whom you want, or a voluntary transition. But we do know that it could be involuntary. Type into your chat box what would be an involuntary transition, a transition that's not really under your control, and that'll give you an idea. So just type in your chat box and see if you can see anything. And I'm going to keep on going about this. So a transition can be voluntary or involuntary. So voluntarily means I want to change my lifestyle. I want to have a choice of when and how and who I do this. There's an opportunity for me to do something else, or maybe I want to take some chips off the table and reduce my risk. But we definitely know there can be some involuntary transitions, and that can happen in the event of these 5 Ds. Death, the big D. Disability, I'm unable to do my work or to manage this company anymore. Or we disagree. I disagree with my partners. I disagree with the rest of the people in the business. Sometimes a transition can occur because of a divorce, and sometimes a transition can occur because of debt, financial failure. But as we prepare for a voluntary transition, we're actually putting the steps in place, the safeguards, to protect the company and your family from an involuntary transition. We're going to show you how to protect the family and the business from a death, an untimely death, a disability, a disagreement, a divorce, and possibly debt. So we are planning all those things while we plan for a voluntary transition. The other choice that you have as a business owner is to transition your business inside the family or maybe inside the business to an employee group. The transition process is not that dissimilar, or you have the ability to transfer it outside, to sell it somewhere. And again, the process of preparation is almost identical. Preparing to sell the business outside, for example, you want to ensure the business is operating at its best. You want to ensure your tax plans are in place and that it's attractive to a buyer. Well, all of those things make it very attractive and for an inside buyer, a family member, because it'll have the best opportunity for success. So there's lots of reasons to plan ahead. In being part of a business family, having family members with you in the business is complicated. And when we plan for this, we plan for 3 different systems plus 1. Some of you may have heard of the 3-circle model developed by a couple of Harvard professors by the name of Renato Taduri and John Davis. They did an in-depth study on family business and came up with this very effective model to help families understand the complexity of their situation and also to help advisors like us develop ways for families to cope and to manage those systems. I'm going to go through a very quick rendition. If you want to hear a longer rendition from me, you can go to a podcast called Inception Family Wealth Hour, and where I had an interview by author and lawyer Chris Delaney, and we went through a lot of this at that time. Basically, this 3-circle model, the systems model, says there are 3 very important systems in which family business members reside, and the systems are very different. They have different objectives, they have different members, they have different needs, different ways of communicating and making decisions, and they're very distinct. Difficulty is, and the complexity is, that they overlap. They impact each other. So when you make a change or a decision in one system, you inevitably impact the others. So again, moving forward, one of those systems, and probably the most important, is the family system. This is where all of your family members hang out. Your family members are part of the system by having your name or being born to you. They are part of your family system. In the family system, we love our family members. We want to nurture them, protect them, help them become the best people they can be. The family system is a safe place. In the family system, we have a unique way of communicating with each other. We might be loud, we might be quiet, we might bicker and chew, we might be very loving. But the family system is unique. It's designed for a specific purpose to support family members. The second system, however, is very different than the family system. It's there to make money, the business system. It's measured by sales, by profit, by margins, by working capital, by debt structure. The business system, in order to get to the business system, presumably you have to have some skills and some drive and some ability. And businesses have to make decisions based on fact and process and some intuition. Very different from the family circle, but we all know sometimes family situations can influence the policies of the business or the decisions of the business, and vice versa. Conflict in the business can sometimes cause conflict in the family. So it's very complicated between these two. The third system is the ownership system or the family wealth system. In the ownership system, we are trying to protect the family wealth, build it, prepare for the future, be fair in the ownership circle. We want to be fair to all of our family members. So the owners make different decisions and the owners of the family wealth make different decisions. Again, those circles overlap. And it is that overlap that makes it very complicated. Most complicated area is right in the middle, probably where most of our listeners are, in the middle. I'm a family member who manages a business that he also or she also owns. Which hat am I wearing when I'm making these decisions? So when we plan for a transition of a family business, we need to consider all three of those circles and prepare them appropriately. Now, if Tagiri and Davis's model encompasses these three circles, I've added a fourth, being yourself. I think every individual who's part of a family business and who is going through transition, whether you're coming in or exiting, you need to prepare yourself. You need to figure out why and how and what am I doing here and how am I going to show up and respond and how am I going to succeed. So we have these integrated systems. It's complex. They overlap. Each of them impacts the other. How do we deal with all of this? And what happens if we don't do a good job? What if we don't effectively do this? What happens? I'm going to go through quickly. I think, there's possibility that the old owners and the new owners don't really get along, or the new owners don't get along themselves. I can't get my equity out because I haven't prepared it well enough. There's not value there. There's not cash flow. There's not a way to get my money out of this thing. And in-laws could become owners. That may be a good thing, and it may not be a good thing, but it is one of the outcomes. I can't afford to treat my kids equitably or fairly, whether they're in the business or not in the business. How do I treat them fairly? Have I figured that out yet? As Wayne will tell you, you could have a large tax bill, or if you plan appropriately, maybe you won't have. But if you don't do a good job, you maybe will. I can't leave. The next generation is not prepared to leave this business, and I haven't put the right management structure in place, so I can't get out of here. And maybe I can't sell because my partners won't let me, or the business isn't attractive for a buyer. Maybe the owners have different goals. We're going different ways, different directions. That can cause a lot of problems, and ultimately, maybe the business will fail. Worse than that, maybe the family fails. So there is a lot of risk. So in the way we talk, the way we believe is that planning ahead helps reduce that risk. Being very clear on what's supposed to happen, prepare the business, prepare each of those circles for that eventual transition, because we all know that it's going to happen, either voluntarily or involuntarily. So really, you should be prepared most of the time for some level of transition. So I often use a funnel to kind of explain our way of helping families through this transition process. The funnel being an analogy for the journey, the process itself. And what the funnel tells you is that at the top, it's not very clear. We're gathering information, we're exploring things like values and visions and principles. And we're just trying to figure out all of the ingredients that have to go into this. So at the top of the funnel, it's not very clear at all. We're still trying to clarify things. As you move down the funnel, you start to talk maybe a little bit more about goals. You provide a little detail to it. You start to recognize the challenges or the issues you've got to face. You develop strategies and actions that you're going to implement. And then eventually, as you get down to the bottom of the funnel, it gets crystal clear. We've planned it. We know where we're going. We know how we're going to do it. Let's sign this document. Let's make all of this stuff happen. So that is kind of the process. It goes from the wide end of the funnel down to the narrow. So in the BDO world, we have a process that we take our clients through called Build the Plan, and it is about preparing. So we're talking about kind of two phases here. The first phase is building the plan, understanding where we're going and how we're going to get there. And the second phase is actually implementing things. Implementing the actions, and that's why JP and Wayne are here, because they're highly involved in the implementation of this. So in Build a Plan, we obviously start with discovery. We need to know the client. We need to understand their current situation. We look at documents, organizational structures. Maybe we talk to people, figure out what they are, and we educate. Being part of a family business is complicated. And thankfully, there is a fairly wide body of knowledge out there in this field. So it is possible to get to be more knowledgeable about family dynamics, more knowledgeable about governance, a little more knowledgeable about management of a business, about conflict resolution, about tax, about corporate structure, those types of things around governance. And then probably one of the key elements is developing a vision for the future in each of these circles. Understanding where the business is going, trying to be aligned on what we're trying to achieve here as far as future leadership and direction of the business, so that we have some harmony amongst the people who are actually going to lead the business. Having a vision for ownership and a purpose for family wealth, how we're going to be fair in broad terms. We're still at near the top of the funnel. It's a little fuzzy. And also having a vision for your family. What's important to our family? Is it faith? Is it community? Is it integrity? Is it being a loving, caring, supporting group to each other? Let's build the vision so we understand where we're going and so everybody's aligned with that. Once we've got a vision, we understand what we're trying to achieve here. Well, you know, there's going to be some challenges. There is some unanswered questions. There's things we're going to have to address on the way. Let's figure out those. Let's identify all of the challenges in a nice, safe, objective way so that we can deal with everything that's going to that we think is going to trip us up and find the answers. And so what we do is develop strategy. What are the things we're going to do to address the challenges we're facing, to answer the questions that we've got in order that we can reach our vision? With the strategies, we need to develop an action plan. How are we going to put these things in place? What comes first and second and third? Who's going to help us with it? When are we going to do it? And then eventually we're at the bottom of the funnel. We're actually going to make things happen. We sign documents, we transfer ownership, we transfer leadership, and off we go. So I asked him to send out this document. I'm not sure whether she did. Maybe she'll send it out after the fact. This gives you some ideas on things that we have recommended and implemented for family businesses in each of those 4 systems. Just some of the ideas for strategy, what you can do in each of those 4 systems to prepare them and actually execute a good transition. I'm not going to go through all of them, but I'm going to go through some of the key ones. In yourself, I think you need to understand what your motivation for transition is, whether you're exiting or whether you're entering or whether you're going to become a partnership between generations. What's your motivation? Why are you doing this? And then look at your own personal vision and the goals, the things you're going to try to achieve. If you're exiting or kind of phasing out, perhaps you want to look at what post-business life looks like, or what you're going to accomplish. Retirement, I think, is scary to some people. So let's have a vision of what we're going to try to do, and then maybe we'll get an action plan together to make the next stage of our life as productive and fulfilling as that first stage has been. And by the way, you might want to check with your spouse. I know that all the people on our call here have perfect relationships and very transparent. Some people I've met, maybe husband and wife don't exactly know what the other's thinking. So having that alignment is very important. Getting into the family system, you might prepare by having family meetings, talking about business transition, talking about who might be the leaders, and also supporting the kids that aren't part of the business, and ensuring that they've got some information so that they understand what everybody's going through. Need to develop family vision and connect around your values. It's a very powerful exercise. It's a connecting exercise. It does reinforce that family is the most important system here, and that's why we try to do this well to keep the family intact. We have an exercise called a family participation plan. How does a family member have a career with the family business? What must they accomplish before they get there? What must they be like? Does the business need to have somebody? How do we actually prepare to have a career in the family business? Once we get in there, what does it look like? How do we choose our roles? How do we move up in the business? How are we compensated? How can we eventually become leaders? And then the family participation plan would describe how can we become owners? What does that look like in broad principle? And make sure your family understands the role of money. What's your relationship with money? Am I entitled to wealth, or do I have to earn my wealth? Is my wealth used for a good, or is it used for my own purposes? How do we treat wealth in our family? I think all of those things can help your business family become adjusted to transition and in future life. In the business circle, we're looking at the management of the business, preparing it for transition, making sure it's got the best opportunity for success. Communication is a big deal, how we talk to each other and make decisions. As the parents exit and the next generation comes in, the decision-making dynamics change. We've got to manage that. Having a business plan that aligns all of the future leaders of the business is important. Let's fully understand where we're going and how we're going to get there from a purely business standpoint. And then, do we have the roles in order to take it there? What do I do? What do you do? What's my authority? What's your authority? When do we have to make decisions together? And then developing those next generation leaders to be able to take leadership and being very clear on how the senior generation exits leadership. So preparing the business to continue and be successful is an important part of transition. And then looking at ownership and family wealth, which is what Wayne and JP are going to be dealing with, having the principles of ownership in plain, understandable language. How are we going to deal with each other as owners? I think is a critical exercise. How do we get in? How do we deal with each other as owners? How do we make decisions? How do we get out? Let's talk about in real plain language how we want to be owners together. Eventually, we can distill that down and put it into a shareholders agreement that can protect us from that death and disability and disagreement and divorce and debt legally. I think the exiting owners, it would behoove them well to have a personal financial plan, understand where their money's coming from. Do they have enough wealth to sustain them? And what does it look like? And what we're going to deal with after I'm done is about ownership transfer. The actual process of transferring or admitting new owners and exiting the other owners, some of the value and tax implications of it. And then ultimately, you want to tie it all together with a great estate plan so that even if something happens, if you happen to pass away, that everything's going to be nice and orderly. It's going to get to your intended destination, and we're not going to pay the government a whole lot of tax. So if you do a good job at this, we're going to have a harmonious ownership group. We see this world in the same way. We're going in the same direction. We can make good decisions together. There's very clear criteria for the next generation coming in to be owners. They know how, when, and what they have to accomplish. There's a perceived fairness amongst your family. This has been done fairly. I'm okay. Not necessarily equally. That's all right, but it's fair based on all of the circumstances. Obviously, we want to minimize tax, and we want to have some funding for tax and maybe the distribution or the allocation of our estate eventually. We've got great communication and great decision making because we prepared the governance of the organization, and we have the ability to exit because all the ducks are lined up, and we've got some good success in the business. So there's a lot of reward to doing a good job for this. So implementation is very key, and we've got some experts to help us with that. So I am going to turn it over to JP Barnaby, my partner, business partner, and he's going to take you through what some of the area issues around valuation are. I'm going to stop sharing. Okay, I've stopped sharing, JP.
Thanks, Brent. Let me just share my screen here. There we go. Can you see it okay?
Yes.
Great.
Very good.
Thanks, Brent. So yeah, thanks for the introduction, Brent. So I am a partner at BDO. I work in our financial advisory services department. So what does that mean? I have my CBV, my chartered business valuator. So I specialize in assisting companies in valuing their business, and whether that's for transition, family transition, or potential external sale, or in the the not great situation of shareholder disputes or matrimonial matters as well. So today I'm going to go through, why is valuation important in transition, and then also how you can work through better your business as far as the value is concerned, and what process you can take in doing that as part of the transition. Quick disclaimer, and I think this relates to Wayne's presentation as well. The presentation contains general comments, and it shouldn't be acted upon without the advice of a professional. So transitioning your business, why is valuation important in family transition? I'll be discussing that, but also, again, what can be done to prepare your business for transition. So I'll be going over almost an action plan or areas to target that you can prepare your business for transition. It's very similar to what you would try to do in an external sale, because you want to set up your family members, if you are transitioning to family, well for success. And I'll go through some important considerations in going through that, as well as some housekeeping items as far as other considerations to look into on transition. Again, similar things to what you would do in external sale, but this relates to transition. So valuations, what is a valuation? And just very quickly, what is a chartered business valuator, which is a designation that I have. So maybe I'll quickly touch on the CBV designation. I'm sure you're all familiar with the CPA designation, Chartered Professional Accountant. Chartered Business Valuator is a separate designation that specializes in the valuation of business interests in businesses. It's a 2 to 3 year program, and similar to CPA, writing similar exams, and so really specializing specifically in valuing businesses and business interests. So what is a valuation, and why would you want one? So as I discussed earlier in my presentation, so there's several reasons, one being family transition, but also others including matrimonial matters, shareholder disputes, also to support reorganizations. So as Wayne will touch on later, there's several tax reorganizations that can be done as part of a transition, and in order to do a lot of those reorganizations, there's often a valuation that's required in order to support the value of the company and what the value that's flowing from one set of shareholders or individuals to another. And so Wayne will dive into that in a little bit more in detail. So why is valuation important in a transition? I have there, normally it's a good first step, but it's not maybe the first step. Brent went through his presentation, and it's important to have alignment within the family first, and a direction and an action plan. So in the implementation point of view, it might be a valuable first step, or one of the first steps, but certainly not the first, as Brent would say. So why is it important? So in order to plan and ensure that the action plan is done on an equitable basis, and that that there's an open and honest discussion occurring, knowing what the value of the business interests is very important in having those conversations, as Brent is very well familiar with. In planning the transition and looking at financial wealth, and is that going to be enough for the exiting shareholders to live on? We need to consider what the actual value of the company is to determine if there is enough money there for the exiting shareholders to live off of, and other determinations, such as if the exiting shareholders are going to be getting paid for their interests, and if so, how will that be paid? That's a conversation that's often had alongside the tax piece. But once the business is transitioned, if it is being paid over a period of time, can the company sustain that level of cash payments in order to both support the exiting shareholders in their lifestyle, but also to continue to operate the business and reinvest and grow and really set the business up for success? So all of these questions, are mostly addressed in evaluation, and having that information contained in a report where we can openly discuss with all parties involved, what does this mean? How can this value transition, or will it be transitioning to from the exiting shareholders, and will the entering shareholders be paying, and if so, how will they pay? So very important questions and very important discussion points, and really that's why evaluation is a good document to start that conversation. I just very quickly want to discuss the types of reports that CBVs, Chartered Business Valuators, can present or prepare. Calculation level report, estimate level report, a comprehensive report, and then we also prepare advisory level reports, which are pricing analyses. If you're familiar with the accounting world, I would compare these to notice to reader, review, engagement, and audit statements. The calculation level report is a cursory overview and summary of what we think the value would be. We're not doing a deep dive in research and analysis. We're reviewing the financial statements. We're having discussions with the business owners to get a good understanding of the business. But certainly we're not doing what would be compared to an audit or any of that nature, as far as, are the numbers fair and accurate. We rely on management representations for a lot of the information that we're gathering. So a calculation level report is often good enough for, having those discussions as far as business transition and family members. It's also good enough and a sufficient amount of work to support tax transactions. However, if the situation is a little bit more litigious in nature and there's some conflict there, we would generally recommend going, having a valuation report prepared a little bit more in depth on the estimate report or comprehensive report level. And the reason being is that there's just a little bit more backing and research and corroboration of facts, figures, and information to help support the value, to ensure that there's sufficient work done behind the ultimate conclusion to be able to stand behind it. So just wanted to give you a quick overview of the types of reports evaluator can prepare. I'll also briefly dive into the high level considerations of evaluation and how we arrive at value. I'm not going to go too in depth in this, and certainly if you have questions afterwards, I can address them. But really, value is derived from two aspects. It's the assets that are used in the business in order to generate cash flow, and it's the cash flow that's produced from the company. And those two, at a very, very high level, those two things combined is what really drives value of a company. So the balance sheet considerations, this is related to mostly the assets used in the business. Things that we look at include, PP&E there, that's property, plant, and equipment. So the equipment that's used in order to generate the cash flows, the nature of that equipment, the value of that equipment is something we look into, and certainly is included in the valuation conclusion that we come up with. Working capital is a big consideration. Private companies often operate with maybe a little bit more cash than they need, just in case, the rainy day fund. But in reviewing the valuation, we generally review, what is an appropriate level of working capital or cash to be kept in the business, and what could eventually be pulled out. And this is an important one, especially for any transition, whether it's a sale to a third party or a transition to a family member. What level of working capital can be left in or should be left in, and what should be taken out. Depending on the situation, taking out all of the cash from a business and just leaving whatever's left in the business in order to operate might not be a great idea, depending on seasonality and the requirements of the business in order to pay the day-to-day bills. If there's no appropriate line of credit in place, this could put the company into a very poor financial situation. So what is that right number? What is the right number to leave into the company, and what is an appropriate number to be pulled out, if any? Debt is certainly a consideration as far as coming to a value of the shares. Obviously, questions come into play as to if the exiting shareholders it's up to them to clear that debt, or if that debt will continue to stay in the company, and that obviously impacts value. But also, how will that debt be paid off over time, and the company's ability to pay that debt off over time. And then ultimately, other redundant assets. So in family businesses, we often see situations where there's assets that might not be used actively in the business, and you get into the situation where it's an individual's personal a piggy bank where they're using to buy cabins and all the rest. And so we want to ensure that the company is clean and ready to take over by the new shareholders. And so that's certainly a consideration that we look at in valuations. And then finally, goodwill and intangible assets. This is a big one and is really driven by cash flow and the growth of cash flows, and is ultimately what we come up with as far as what is that value to customers, what is that value to relationships, and we work through that with the business owners. Very quickly, this is the cash flow side. So in coming to a company's cash flow, there's lots of discussion as far as what is maintainable and what are necessary expenses or not. So this is something that we go through with business owners in transition. One important one is, if the real estate is owned by the company or owned in another corporation that is also owned by the existing shareholders, and if that real estate is or is not transitioning, this is somewhere where we can step in and assist the family or the business owners in determining what is an appropriate fair market rent that to be charged between companies, what is an appropriate salary to the existing shareholders that might be exiting, how long will they be staying on, and what are the services that they'll be providing. These are all discussion points that we go through in preparing the valuation and calculating what is the earnings of the company in a valuation. Very quickly, wanted to chat about value drivers and value detractors, and why is this important if we're just dealing with a family business? Well, as I mentioned, it's important to set up the next generation for success, and so really preparing the business for an external sale is the same process you want to go through in preparing the business for a transition. So a few key things that I wanted to focus on from this slide is one being the management team, or the reliance on the existing shareholders. That's a very big one in transition is, and I always ask the question, what happens if you get hit by a bus? And so that's the question we want to answer and try to find an answer for. If the company is very reliant on the existing shareholders in order to operate, that really detracts from the value of the company, and we want to make sure that it's not reliant and can transition appropriately, so that the exiting shareholders can step away from the business. A few other comments on this slide. Another big one is customer concentration and the way in which revenue is derived. You can't always manage how that looks and how your revenue is derived, but certainly a company that is very concentrated on one or two customers, there's a lot of risk there. And if on transitioning the business to the next generation, there's a lack of there's not an appropriate amount of work in transferring those relationships, and one of those customers were to leave, that's a significant issue that impacts value and impacts the ability for the company to continue to operate as profitably as it did prior to transition. And a few other considerations before I move on or transfer to Wayne in preparing the business for transition. And again, this is similar to as if you were transitioning it or selling it to an external party. You want to make sure that all your agreements are up to date within shareholders. So whether that's having formal contracts with your management team, with your key employees, even updating leases, these types of things are very important. Tidying up the balance sheet, as I mentioned previously, trying to get rid of any excess assets that are in the business that might not be required, the snowmobile or the tractor, or potentially going through that and determining what's needed, what's not, and getting those types of assets out. There's also liabilities that you might want to clean up as well. Optimizing the operations. So, similar to almost selling a house, you want to make sure the business looks good, tidying up all the assets, making sure you upgrade as necessary, and you don't want to be leaving a bunch of capital investment that needs to happen to the next generation. So you want to make sure that you've invested appropriately for the business to continue to operate properly. Making sure your accounting is rigorous and up to date is very important. If you're transitioning either externally or internally to your family, you want to make sure the records are clean and transparent, and so that it's everyone's in the know as far as what the company is making, and as far as cash flow is concerned, and you know, the expenses that are run through that company. Documenting your business plan and forecasting, dealing with unidentified problems or items that might not be recorded on your financial statements, such as, you know, any claims or lawsuits, as well as environmental liabilities. And other considerations, including how long are the exiting shareholders going to be in place and help in the transition? Are they expecting that they're going to leave tomorrow, or are they expecting that they're going to continue to be involved for 10, 15 years down the road? I think there's issues with both of those situations if there's you know, individuals trying to take the business over and operate it the way that they'd like it to operate. So, and finally, make sure you have appropriate tax planning in place, and that's where I'll transition it over to Wayne.
Okay, thanks, JP. I just want to make sure that you can hear me.
You bet.
Perfect. Okay, so before we get to the part of the presentation that everyone's been waiting for, I just want to check in with Kim about timing. It's 11:46 by my clock. I just wanted to check whether we had a 12 o'clock hard stop or whether we could go over a few minutes.
Oops, we can go over a few minutes.
Okay, wonderful. I'll try to get through my piece as quickly as possible. So just, I guess, as a bit of an introduction, oh, I guess, can everyone see my video?
Yep.
Okay, perfect. I don't see it on my screen. A bit of an introduction as far as what I do. I'm a tax partner at BDO. So once Brent and JP have done their terrific work to figure out what everyone's wants and needs are and what the values are of the business that we're dealing with, that's when I step in, and I work in close conjunction with the families and the company's lawyers to actually implement the corporate changes that need to be made in order to facilitate the transition to the next generation. So I have a limited amount of time, and I think I just like to sort of touch at a relatively high level on a few concepts that we use in tax to try to achieve people's objectives when transitioning to the next generation. And similar to JP's caveat, I just wanted to say that not all of these planning ideas are relevant to every situation. Some work in some situations, some work in other situations. You really need to have a comprehensive conversation with your tax advisor to see which of these, if any, work for you and your family. So that being said, there's a few concepts I wanted to go over. One is something that most people have probably heard of, the capital gains deduction. I'm going to touch briefly on reserves, the concept of the wasting freeze, which we use quite often in a family business transition. Safe income strips, which can be useful from time to time. Separating real estate, it's a great way to prepare for an ultimate disposition. Gives you a lot more flexibility. Family trusts, which again provide flexibility when all the decisions haven't necessarily been made. And then just touch on estate planning. So JP, go on to the next slide. So most people have heard of the capital gains deduction. It is it's a deduction that's available on the sale of shares of a qualified small business corporation, which is a defined term in the Income Tax Act, or shares of a family farm corporation or qualified farm property. I'm not going to get into to farms. This is really one of the most popular and most lucrative benefits that small business owners get from the tax system. As of 2020, I should say 2020, the capital gains exemption or deduction is $883,000. So that means that the first $883,000 of capital gain on the sale of a shares of a small business corporation are not subject to tax. So that's a benefit of about $236,000 in tax savings, which is pretty substantial for most people. So it's something that we try, if possible, to get access to. Next slide. The point that I wanted to make, I don't want to get into what all the tests are to qualify for this deduction, because that could be a 2-hour presentation in itself. But I did want to mention that in a family transition, it can be more difficult to access the capital gains deduction. The reason for that is the policy reason for having a capital gains deduction is to reward people for growing a small business and then selling it to an arm's length person. It's not to transition it to the next generation, because the whole idea is they don't want people to be able to access the benefit of this deduction without the business moving out of the family. So in order to get the deduction within a family, you have to do a personal transaction, which means that the next generation has to buy your shares personally. And of course, the problem with that is they have to come up with money. You can't use the corporation's money to buy the parents out. So what we, what often we see in an arm's length transaction is, maybe the purchaser already has a business. They use the money that's in that business, so it hasn't been subject to personal tax yet. And so they have pre-tax income or pre-tax cash in their company that they can use to buy your company, which is a big tax advantage. Whereas you can't do that within the family. You can't have the child set up a corporation and use corporate money to buy the parents' shares. There's anti-avoidance rules that prevent you from doing that, which, a lot of advocates for small business have said is a disadvantage for families, and we need to change the rules to make it easier for families to transition their business. Okay, JP, next slide. A reserve. This concept is really just saying that within the Income Tax Act, there's specific rules that say that when you have a capital gain, you only have to pay tax on that capital gain as you receive the proceeds. You can that rule is eligible for generally speaking for 5 years. So you have to pay tax on a sale over 5 years minimum. Depending on how you receive the cash. But if you're selling to the next generation, that gets changed to 10 years. So you get to bring the capital gain in over 10 years instead of 5 years. So, that's if you're taking back a promissory note as opposed to cash, which is an advantage for family transitions. Okay, next slide. Estate freeze. You may have heard of the concept of the estate freeze. And what this means is the business owner exchanges their existing common shares or their growth shares for fixed value preferred shares. And those preferred shares will have a value that's fixed and is equal to the current value of the company. And of course, we would have to ask JP for what that number is. And that's sort of how he would play into a transaction like this. And then new common shares are issued to family members. So, for example, the next generation. The reason that we would do something like this is because when a Canadian individual passes away, they're deemed to have disposed of all of their assets at fair market value, and to realize capital gains on that value. By doing a freeze, we fix that value at the current value, so that any future increases will go to the next generation as opposed to the existing shareholder, which keeps his value in the company from going up, which also increases his tax exposure on death from going up. And that allows us to manage that tax liability in the future, either by life insurance or by using other assets to make sure that we have the cash available on death to pay that tax. So it sort of stops the problem from getting worse. Okay, next slide. And then that brings me to the concept of the wasting freeze, which we use quite often. So we do the classic estate freeze, which leaves the existing owner with fixed value preferred shares, and we start redeeming them every year. So let's say they have $5 million worth of these preferred shares from the freeze. We start redeeming them as they take cash out of the company for their personal income needs, which reduces the number of those preferred shares that they have from the freeze. And every time they do one of these redemptions, it reduces the value of their estate and reduces the amount of tax that they'll pay on death. So it's a way of drawing cash out during retirement years out of the company and having the double benefit of reducing their tax that will be paid on death, because, like I said, the preferred shares are going down in value because they're redeeming them, and sort of they're taking a piece of that money off the table every year. So if they can live long enough and take enough cash out of the company to redeem all their shares, they won't actually have any tax on death because they'll have received all of that money already, and they won't have any of these preferred shares left. All the value in the company will belong to the next generation through ownership of the common shares. So that's a very quick explanation of a estate freeze and a wasting freeze. Next slide. A quick example. You know what? I think we're going to skip this because I already gave an example. Safe income strips. So if we were actually going to sell the company to the next generation at fair market value, so let's say the kids are going to borrow a bunch of money personally and buy the shares from the parents. What we sometimes do is we'll set up a holding company for the parents if they don't already have one, and we'll pay a dividend from the operating company up to the holding company. It's a tax-free dividend, which is limited to what we call safe income. And what that does is it reduces the value of the operating company and makes it more affordable for the next generation to purchase. And it also reduces the amount of capital gain that that the current owners would have on such a sale. It's a pretty, what happens is because there's generally not enough cash available to pay that dividend, it gets paid by way of a note, and then the kids will pay that note off out of the operating company over time as they earn income. Okay, next slide. Okay, we'll pass that one. That's just a little more information. A very common technique that we use usually right from the beginning of a business cycle is we advise our clients to put their business real estate in a separate corporation, and then that separate corporation will rent that business that building to the operating company at fair market value. Again, JP might come into play there to help you determine what fair market value of the rent might be. And what this does is it gives you a number of advantages. So first of all, creditor protection. So if you run into issues in the operating company, the land building is in a separate company, and this protects it from potential legal liability in the operating company. The other benefit is when doing the estate plan for the parents, it's possible to leave the real estate to kids that are maybe not active in the business, and then leave the operating business to the kids that are active. Because many families, when they're doing their estate plans, they want to be, roughly equal as far as value to what they leave to their kids. But that can create problems if you have some kids that are involved in the business, some that are not. If you leave the shares to all the kids equally, that could potentially create friction between the active kids and the non-active kids. So this is a technique that we can use along with, other techniques to try to equalize value without getting kids that are not active in the business involved in the share ownership of the active business. Okay, next slide. Family trusts. Again, I could talk for a couple of hours on this subject, but when we have a situation where we want to do an estate freeze and stop the growth from accruing to the existing generation, but we don't quite know yet which kids are going to be the ones that take over the business, or which ones we want to have as shareholders or in what proportion. Sometimes we use what we call a discretionary family trust, and what that allows us to do is have the parents maintain control over the common share. So what we would do is we would do a freeze and have this family trust subscribe for new common or growth shares. The parents would control the trust and therefore can still control those growth shares, but they would have 21 years to decide which one of the kids gets the shares. And once they do decide who's going to get the shares, they can be transferred out of the trust tax-free to those kids. It provides a lot of flexibility. And if you decide that none of the kids should have shares, you can take them back for yourself, and it can all be done without tax. It also gives you the potential to split income, capital gains, and use access capital gains deductions for the kids if there's ever a sale to a third party. Okay, next slide. The last thing I just wanted to mention is, and I think Brent touched on this as well, is that when we're transitioning a business to the next generation, we want to make sure that we take into account the overall estate plan for the family. So we want to make sure that we have updated any wills, probably for the whole family, not just the parents, but if the kids are getting involved in ownership, we want to make sure that they have wills, just in case something happens to them. We want to make sure that life insurance is considered. That is one of the ways that we use to equalize estate value with kids that are not active in the business. So we could use life insurance to generate a pot of cash that can go to the kids that are not active in the business, and then more of the active business can be left to the kids that are actually working in the business. Powers of attorney. It's always important to have those done with your lawyer, both for financial and for your health. And the one thing I didn't list in here is, and Brent touched on it quite a bit, is it's always a very good idea to have a shareholders agreement in place. It makes a lot of sense to get that done while everybody is in agreement, because sometimes when there's disputes and your family members, those disputes can be more fiery than if you're not related. So it's always a good idea to have things down in writing to govern how the business is run and what happens in certain situations. So that being said, I think it is time for questions. Now, Kim, did we have any questions come through?
Not yet. Does anybody have any questions? I had a question and it was answered in the time. I think you've covered quite a bit of it. Does anybody have any questions that they want to put in the chat box, or you want to unmute yourself, or you can actually chat privately as well if you want to chat privately with somebody in the session.
Hi, Kim, this is Vicky. May I ask, just unmute myself and ask Wayne a question?
Absolutely.
With regards to the wasting freeze,
Yes.
you had talked about that the original owners would get a dividend so that there would be less taxation when the transition took place. Have I got my mind around that right?
Right. So yeah. So what happens is, let's say we, just to keep the numbers easy, there's $1 million of value, and we do the freeze, so they have $1 million of preferred shares, and they need $100,000 for the next 10 years to fund their retirement. So what we do is we redeem $100,000 worth of those preferred shares each year for those 10 years, and for tax purposes, that's deemed to be a dividend. So they're going to pay tax, say $10,000, assuming it's an eligible dividend. So have $90,000 left in their pocket for a 10% tax rate. And at the end of the 10 years, their preferred shares are all gone. So the next generation owns 100% of the company.
Okay, all right. The other question I have is, it sounds like this is very complex, and I guess I knew it would be, but how many years in advance should people start this planning, transition planning?
I would say the earlier the better.
Like years?
Yes, absolutely, years. Because some of these, like for example, on state freeze, that often gets done 20 years before you transition to the next generation. It all depends on how much value has been built up, and your family situation. Like I said earlier, every situation is different, but it's never too soon to start having conversations with your advisors about your estate plan, because
Okay.
the earlier you start, the better.
All right, thank you very much.
Wayne, we had another question for you. Can you please explain a little more about the freeze and the discretionary family trust processes?
Is there something specific? Because I could, like I said, I could go on for hours about that. Was there a specific question about it? Like, I tried to hit it at a as high level as possible.
Would you like to unmute? Oh, okay. Would you like to unmute yourself? There we go.
Hi, Wayne.
Hi.
Just the first question. Can you explain a little bit the process you use when you mentioned the freeze and the discretionary family trust?
Right.
So I have a case basically that I would like to give them a briefly advice on that. So that's why I'm asking.
Okay. So what we do is first thing we do is we get a valuation.
Okay.
Because we need to know what the company is worth, because that forms the basis of calculating how many of these preferred shares the existing owner will get. And the Canada Revenue Agency is very particular, excuse me, very particular about having a formal valuation that is that would stand up to their testing. And then what we do is we work with the lawyer to do the legal documents to get that the share exchange done. And then in terms of the family trust, that is a trust is essentially an agreement between what we call the trustee who and the settlor. So the settlor is the person who is creating the trust. The trustee is looking after the assets on behalf of a third group, which is the beneficiaries. Okay. So your beneficiaries will normally be your family. The trustee is often the the parents. Could be a valued advisor or family friend or something as well. And what happens is that trust is a separate taxpayer, and it subscribes for the new growth shares in the company.
Okay.
And anything that happens with those growth shares is determined by the trustees of the trust, which is the parents. And if dividends get paid on those common shares, they're received by the trust, and then they can be allocated to the family members. There's other tax rules we have to be aware of, but and that's really it. So and then any time in the future, the trustees can decide to transfer some or all of those common shares to any of the beneficiaries.
Okay,
So it gives you flexibility.
So to the best of my understanding is that the better is the whole process to start way before problems arise, like deaths or something like that, right?
Oh, absolutely.
Yeah. Okay.
So yeah, so I just want to be clear that the value of the family trust is where you haven't decided 100% which kids are going to be taking over the business.
Yes. Yeah. Okay.
Or in what proportion.
Okay. And one last thing, when somebody wants to have more depth conversation with you, how they can reach you?
That's a good question. Kim, can you distribute contact information?
I certainly can. I can distribute it to everyone as long as you guys are comfortable with that.
Yeah.
Okay. Thank you so much. Thank you for your help.
All right. And I think that's it for questions. I want to thank you guys. This was a very informative presentation. I think our attendees may be small, but I think they all got a lot out of this. So I appreciate you taking the time to do this, and I want everybody to have a good day. All right. Thank you.
Very good. Our pleasure. Thank you, Kim. Thanks, everybody, for attending.